If you've ever had a mortgage application declined, or you're worried about being declined, you're not alone. Mortgage declines are far more common than people realise, and in many cases, they're completely avoidable. The problem is that most people don't understand why lenders say no because the reasons aren't always obvious. In this video, I'm going to explain the real reasons UK mortgage applications get declined in 2026, what lenders are actually looking at behind the scenes, and how you can avoid the most common mistakes before you apply. Quick note before we start, this is general information, not personal financial advice. Mortgage eligibility depends on your individual circumstances and lender criteria at the time. Let's start with the biggest misunderstanding: credit score. People often assume that if their credit score looks good, the mortgage will be approved. In reality, lenders don't lend based on a single score. They look at your full credit profile and your behaviour over time. Missed payments, defaults, CCJs, and arrears matter, but so does how you use credit day to day. High credit utilisation is a common issue. If your credit cards are close to their limits, even if you pay them on time, some lenders see that as higher risk. Multiple recent credit applications can also cause problems because it suggests financial pressure or instability. It's not about one red flag, it's about the overall picture. Next is bank statements, and this is where a lot of people get caught out. Even with a clean credit file, your bank statements show lenders how you actually live. Regular overdraft use, returned direct debits, gambling transactions, unexplained cash deposits, or large transfers without explanation can all trigger questions from an underwriter. Lenders aren't judging lifestyle choices, they're assessing stability. If your statements show your account constantly dipping into overdraft or bouncing payments, the lender may worry about your ability to manage a long-term mortgage commitment. Another major cause of mortgage declines is undisclosed or underestimated commitments. When you apply, you're asked to declare loans, car finance, credit cards, childcare, maintenance payments, and other outgoings. If these don't match what appears on your bank statements or credit report, that's a red flag. Even innocent mistakes can cause issues because lenders hate inconsistencies. Car finance is a big one. A $400 or $500 monthly payment can significantly reduce affordability, especially once stress testing is applied. Income issues are another common reason applications get declined. For employed applicants, this might mean inconsistent pay slips, recent job changes, probation periods, or variable income that isn't accepted in full. For self-employed applicants, it can be declining profits, missing documentation, or misunderstanding how income is assessed. Limited company directors are a particularly common problem. Some lenders only consider salary and dividends, while others may include retained profit. Applying to the wrong lender for your income structure can result in an unnecessary decline. Property-related issues can also cause mortgage applications to fall over. Even if your personal finances are strong, the lender has to be comfortable with the property itself. Down valuations, short leases, non-standard construction, cladding concerns, or unusual property types can all lead to declines. A mortgage is secured on both you and the property. If either side is considered too risky, the lender can say no. Timing matters more than people think. Applying too soon after missed payments, job changes, or major financial changes can significantly increase the risk of a decline. Lenders like stability. Sometimes waiting a few months, improving your bank statements, or letting your credit profile settle can make all the difference. So how do you avoid these problems? First, check your credit properly, not just the score, but the detail. Second, stabilize your bank statements for a few months before applying. Third, reduce unsecured debt where possible, especially high credit card balances. Fourth, be accurate and honest about your commitments. And fifth, make sure the lender fits your situation, especially if your income or property isn't straightforward. A mortgage decline doesn't mean you're bad with money, or that you'll never get a mortgage. It usually means the application wasn't structured correctly, or the timing wasn't right. If you found this helpful, subscribe for more straight talk videos on UK mortgages, borrowing, and common mistakes people make. In the next videos, we'll cover fixed versus tracker mortgages, self-employed lending, and remortgaging decisions in 2026. Thanks for watching. Borrowing power depends on lender appetite, not just numbers. Comment appetite if you want options.